Welcome to our first English episode of the market analysis. I'm William, I'm your host from PDS Prop Firm, and joining me is Jay from Derivative Trading, a professional trader and market analyst. This week, the longest government shutdown in history just ended. Gold is knocking on some all-time highs, and China is making some aggressive moves to international the yuan. Welcome, Jay. How are you doing?
I'm fine, and you? Thank you for your warm welcome. It's always a pleasure to connect with your audience and discuss the critical market trend.
Amazing, Jay. All right, so let's dive in. The 43-day longest shutdown ever in US history. Market rallied, but here's the twist. The jobs and inflation data may never be released. So what's the market sentiment by the end of the shutdown?
Well, on Monday markets were quite optimistic. Everyone hoped the shutdown would end, which led to a rally in stock markets and all risk-sensitive assets globally. This initial buying, I should add, came largely from systematic funds like volatility control funds, which came back as market volatility eased. But this momentum started to slow down by Wednesday. Then, yesterday, Thursday, something shifted. After the shutdown officially ended, US stocks actually saw a significant drop. The S&P declined, and large tech stocks faced a big sell-off yesterday. This was because that initial optimism was likely already backed into prices. Expectation for December Fed rate cut fell sharply. This was largely due to the announcement that the October job report would be released without the unemployment rate, as Fed told us that yesterday. And a wackish comment from Fed Reserve official like Ashkari, who seems more focused on inflation risk. The missing piece on job report will make the Fed decision much harder for December, suggesting they might defer any rate cut until January or later. To put in numbers, overnight swap went from pricing nearly a 70% chance of a December cut to less than 50% just now. However, it's important to put this into perspective. While movement might have seemed sharp on major US indices, it was actually just some profit taking in tech stocks and sector rotation in favor of defensive stocks. To your audience, this highlights why you shouldn't solely focus on a single index.
If you want to start trading futures without risking your own capital, join Phidias Prop Firm. You get the best trading conditions, the most trader-friendly rules, and you get access to live funding once you're proven profitable. Click the first link in the description below and use the code PPYT to tell us you come from here. Yeah, definitely. And most traders actually look only at 1 to 2 indices and they miss the entire picture. They miss the full story by not looking at the stocks that compose the indices, which is super important. All right, let's now move to gold, which, as you predicted last week, started the week with the rally back again. But by the end of this week, we are seeing some trouble in the water. What's going on with gold?
Gold is interesting this week. Showed a very strong rally earlier in the week. As discussed last week, the main factor were growing fears of US economic slowdown and belief that the Fed Reserve would cut interest rates soon. It also got a boost from central bank purchases, mainly in China and Asian central banks, and ETF inflow from last week's and this week's. However, that Thursday repricing about less likely Fed rate cut for December could certainly cool gold momentum. This change might create some negative pressure despite its strong start this week.
So, as you said, the biggest buyer of gold is probably China. And China is actually not only buying gold, but they are making bold moves on their currency to internationalize their yuan.
Absolutely. The Popular Bank of China is determined to make the yuan a globally recognized currency. Their main goal is to increase its use outside China. They achieve this by encouraging foreign entities to use yuan loans and yuan-denominated bonds. The yuan current low borrowing cost also make it very attractive. The larger strategy is to reduce China's reliance on the US dollar and to support Chinese companies expanding their goal. It's fundamentally about increasing the yuan influence in the global trade and investment.
All right, so interesting news. And what can we expect as an impact on the markets?
For now, nothing. China wants to increase the yuan influence in global trade, but maybe in the future we can see the yuan as a USD challenger, a serious challenger. But for now, we don't have to be afraid by this move. But in the future, and I guess the US administration is currently looking at that, and in the future we will have some question about that. But for now, nothing.
Okay, interesting. So we are noticing this build-up of tensions between the US and China. Yeah, we'll have to keep an eye on this. All right, let's now move from currency wars to commodity wars. Oil is having his own identity crisis, still in his range for the past few weeks. All right, so what's going on with the oil market and the geopolitical tension?
Yeah. Oil price indeed saw quite a bit fluctuation. On Monday, oil prices initially rose, fueled by hopes that supply restrictions would end. But this optimism quickly faded. Then by Tuesday, price dropped significantly. This was due to the clear indication of a growing global surplus amplified by increased production from OPEC member and other regions. The expectations show that this oversupply will persist. This means ongoing pressure on price, which could help lower overall inflation. However, the oil market remained volatile because of geopolitical tension and recent attack on Russian infrastructure, despite mounting fears of a surplus due to OPEC ramping up production and high global inventories. Geopolitical risks and potential supply disruption continue to support oil prices. Oil traders need also to keep an eye on growing tensions about Venezuela.
Indeed. So what's happening in Venezuela for our English audience? Spoke about it for a few weeks now, but I think we can make a good reminder of what's going on between the US and Venezuela.
Actually, US government is telling us that they are starting a war on drugs in South America and mainly in Venezuela. However, Venezuelan authorities are telling us that maybe a regime change is starting to take place, and they are afraid about a kind of putsch they could see in the coming future. So we must keep an eye on it.
Yeah. If we see a regime change happening in Venezuela, this might have a huge impact on the oil market as the Venezuelan reserves are the largest in the world.
Yes, absolutely. The Venezuelan reserves are big, the biggest in the world. And indeed, if US major start to drill in Venezuela in the future, maybe they can flood the market.
Yes, and obviously we'll update you guys when the situation progresses. Alright, I think we covered most of what happened this week. Let's now move to the coming week. What's expected and what traders need to keep an eye on to prepare the week.
Okay, given the return of volatility, as we mentioned just before, and ongoing concern about the next rate cut, everyone needs to be cautious for next week. Technically, two big events are the VIX expiration and the monthly OPEX option expiration. As we approach these events, market options become more and more sensitive, which can really amplify moves. Something to note is that S&P, Nasdaq, and other indices have shifted back toward negative gamma yesterday, which amplify volatility because market makers sell into weakness and buy future when prices rise in order to stay market neutral. The delayed economic data release will, of course, grab attention. Notably, Nvidia earnings report could heavily impact the market, especially with the growing concern about tech companies' significant capital expenditure on artificial intelligence. So we can expect more profit taking next week. Regarding commodities, oil prices should continue to struggle and could be dominated by a stronger dollar if bets against a December rate cut persist or increase. The same goes for gold, silver, Bitcoin, which will likely face headwinds. On the forex front, we are approaching a critical moment for potential intervention by Japanese authorities on the yen. I guess, as I told you last week, could see the intervention by next week.
Alright, so a pretty busy week to come. And with the end of the shutdown, could we see the October's data being released by the US government next week?
Yes, authority told us that we should get some new data about October by next week. and on Monday I think we should get some of this data. But yes, the attention will be focused on the data.
Perfect. We'll keep an eye on these releases. Let's now move to the trader pro tip. So Jay, what do you have for us this week?
Oh, my main advice for trader as the volatility came back. So whether you are scalping or day trading, if you are a directional trader, high volatility means price can swing much wider and faster, as I explained about market maker delta hedging earlier today. So shrinking your position is a smart way to manage your risk. Better safe than sorry.
Indeed. All right, so when volatility arises, let's decrease the position sizes. All right, so if you guys enjoyed the market analysis of this week, please subscribe to the YouTube channel, click the like button and the bell notification. As always, if you want to participate in the market without risking your capital, join us at phidiasprop.com using the code PPYT to tell us you come from here. All right, Jay, so I leave you with the last word as always.
It was a real pleasure. Thank you very much. Always happy to contribute. And if your audience needs to know more and have questions about volatility mainly, don't hesitate to join us. Thank you very much.
All right, all the links for Jay are in the description below. For next week, we won't have the weekly analysis because we have some exciting news coming at Phidias, but we'll see you the week after on Sunday as we will move forward in English. Have a great trading week and we'll see you guys later. Bye.